Welcome to the IMF-World Bank Spring Meetings at the Atlantic Council. I'm Josh Lipsky, Senior Director of the Council's GeoEconomics Center, and it is my pleasure, along with colleagues from across the Atlantic Council, to bring you a unique series of events over the next 5 days, where we interview finance ministers, central bank governors, development and trade ministers, and dive into one of the most important meetings the IMF and World Bank have seen since the global financial crisis. I could not be more honored to start with our all-star senior fellows who have been with us through many IMF World Bank meetings from Marrakesh and beyond. I want to introduce Nicole Golden, Senior Fellow at the Atlantic Council, Head Equitable Development, UNU Center for Policy Research, Hung Tran, former Deputy Director, Monetary and Capital Markets here at the IMF and Senior Fellow at the GeoEconomics Center, and Martin Wohlheisen, former Director of SPR at the IMF, Senior Fellow at the GeoEconomics Center. Here we go, another IMF World Bank meetings, but a different one. And the backdrop to all of it are the trade wars that are going on. Nicole, let me start with you. How does trade impact what's going to happen here over the next 5 days?
Thanks so much, Josh. And wow, great to be back with everyone again and to be here at IMF HQ2 this time around. And absolutely, what I'm particularly looking for is what we see in the World Economic Outlook and in general on the conversations from the trade wars and tariffs as they impact the developing world, the emerging markets and developing economies, and in particular some of the less developed markets. Not always the first part of the conversation, but an important part of the conversation. We know that these countries are already facing a lot of debt distress, a lot of tightening on their fiscal space, and the trade wars and the impact of the tariffs on these economies is particularly strong. And that's really what I am watching for, what I'm looking for to see what the data says about the early models, what we're seeing of quantifying that impact, as well as just the qualitative discussion around what do we do when we compound, as I said, this already debt distress, the challenging geoeconomic environment, geopolitical environment, and then you bring this on and what that means for the fiscal space. So on the trade, that's what I'm watching.
Well, we'll get our first cut at that tomorrow morning when the World Economic Outlook is released. Certainly probably one of the most difficult WEOs to ever draft given the changing policy environment. Hung, your thoughts on trade and the role of the IMF and the World Bank in the midst of this global trade war?
Yes, thank you very much, Josh. My answer is very simple. I don't expect much in terms of how to address and how to provide solution to the trade wars that we have seen going on in the past 2 months or so, because already the world trading system has already moved from one of multilateral open rule-based system to one which is driven by unilateral action and followed by bilateral retaliation or bilateral negotiation, leaving no room for an multilateral institution like the IMF or the World Bank to really have much to say about it. Having said that, so I think that is still useful if delegates to the meetings here this week can compare notes to assess fully the negative impact of the tariffs and counter tariffs that we have seen on their economies and global economy, and particularly, as my colleague Nicole said, for the developing emerging market and low-income countries, and how certainly the community of the membership should do to address the grievance that President Trump and his administration has highlighted in terms of the persistent trade deficit that the U.S. has suffered and the impact of it on the manufacturing base and employment of the U.S., which his administration attributed to unfair trade practices by other countries, basically turning Uncle Sam into Uncle Sucker. The complaint, in my view, has legitimacy. The action may not be the best action to address it, but the world community really have to address the concern of one of its biggest members, the U.S., and try to retain and keep the U.S. fully and constructively involved in the IMF.
Well, let's talk about the action to address it, Martin, because I was struck in Kristalina Georgieva's curtain raiser last week. She addressed the grievances. I thought she clearly addressed the grievances in a way the IMF really has not so explicitly before at that high-profile kind of event. But I also felt that we didn't talk as much about what launched the trade war, specifically President Trump launching the trade war. We kind of approached that speech last week as if the trade war was just upon us. And so the question is, how does the IMF navigate this moment, which is obviously incredibly delicate for the institutions, but is going to have enormous economic impacts across the world?
So the IMF doesn't have any mandate to cover trade, although its mandate in the area of exchange rate surveillance and global economic surveillance and programs is there to facilitate balanced trade, right? That's in the Articles of Agreement. So naturally the IMF has an interest in what's going on, and they will try to describe in the flagship documents how it looks right now. There's so much uncertainty both ways. It could become much worse. It could also be that there's some agreements on some proposals, and out of a sudden the world looks much more secure. So there's a lot of variety around how the outlook could evolve. So we shouldn't really look so much at the numbers per se, what's being projected, but at the secondary analysis. What are the risks? How could this play out for various countries? What are the tools that the IMF has? First of all, is the firepower enough? I mean, there's been a quota increase, so it's on relatively sound footing in terms of the amount of programs that the IMF could do potentially to help countries, especially those that are dependent on exports, because they're going to be very hard hit if the tariffs stay in place or get even higher. Then there's the issue of how far do the tariff kind of negotiations spill over into other areas? Will there be capital constraints at some point? You know, earlier today already we talked about this Mar-a-Lago proposal that has some elements of a kind of almost a forced restructuring of U.S. government debt. But if there's retaliation on tariffs, at what point do countries impose capital restrictions? Again, the IMF doesn't really have a mandate here, but it affects exchange rates. And so there is the question of how to maintain the international payment system and how to help countries that are hit by such exchange rate shocks. So there is a rich agenda, but it's all kind of a bit behind the scenes, and it's really about the internal workings of the fund and how it could do and how the membership could still support it, although there are disagreements in many areas.
Can I add something?
Yeah, please.
Yeah, I think I'm very, very happy that Martin raised the issue of exchange rate surveillance, because that is squarely within the IMF mandate to promote sustainable and equilibrium exchange rates to facilitate sustained balanced trade over the long run. And I think personally that the IMF has failed over the past several decades to push that point, because the persistence of current account surpluses on the part of some countries like China, Germany, and persistent current account deficit on the part of the US over decades really reflect the fact that exchange rates have not been allowed or promoted to be the equilibrating and shopper to make sure that trades will be continued on a balanced and sustained basis. So that the IMF really has to go back to their drawing board and see how they can come up with a concrete way to address that point.
I'm glad you both raised the shocks from tariffs, because there is going to be a role for the IMF and the World Bank to step in and support countries that are hurt by tariffs. And then this is going to become geopolitical, because if those countries are also negotiating with the White House, there's a dimension to be played out here. It won't be played out this week, but it will be played out in the weeks and months to come. Nicole, I want to turn to you. Believe it or not, there will be conversations beyond trade at this meeting. It'll be hard to understand, but it will happen. If we weren't in a global trade war, what would we be talking about right now at these meetings?
Well, you know, and I think there is actually a lot that we'll be talking about. And it's interesting for me because I'm coming in this year from a new vantage point, from a new role up in New York.
Congratulations.
Thank you, at the Center for Policy Research. And you know, we are thinking about this moment on top of the debt, on top of the trade war. We are in an era of declining development, official development assistance on the bilateral side, and what is that going to look like in terms of these conversations and how there is a thinking about what that means on the multilateral side. These conversations this week is happening as a precursor to next week, the continuation of the financing for development agenda leading up to the 4th conference on financing for development this summer in Sevilla, Spain. And so what does all these kind of dynamics come together, and how does our official theme of jobs, see already, on the top of mind, interact with trade? How does jobs interact with the debt conversation, right? And these are conversations we'll be having this week as part of the series. But that's really what I'm sort of looking out for, is, to your point, there are important topics other than trade, but trade also affects all of these other, it's sort of, they go back and forth, right? Yeah. Jobs affect trade affects trade affects debt affects jobs affect, the ability sort of in the domestic resource mobilization side to sort of create more revenues and maybe alleviate some of that fiscal constraint that the debt and the trade is now kind of placing, especially, like I said, on the emerging market and developing economies. So it's this kind of broad overarching agenda of financing development, kind of filling these gaps that we know are there on climate, on reaching sustainable development goals, and again, on just mitigating the ability of the countries to respond to these kind of consecutive compounding kind of shocks, whether it's debt, whether it's, still recovering from COVID, to be honest, in some of these economies.
Yeah. No, and we shouldn't overlook the fact that tomorrow, Pierre Olivier is going to be right down here, the WEO press conference, and it's going to be a markdown across the board. We'll see what the numbers are, but it's going to be so different than the January WEO, where we were after the election, where we were after the inauguration. And this, of course, is about trade, but it's about jobs and livelihoods across the world. And I think there are seldom single policy actions that have had this kind of global effect in this sort of time, and we're going to see that in stark relief tomorrow.
And the uncertainty around it. Going back to what both Hung and Martin have said, that we don't still know where this is actually going to shake out and land. And that's really a challenge. The uncertainty affects the private investment, it affects the public investment, and that really has dramatic impact, not only on growth, but also, as we often talk about, and again, that's the other piece I would say I'm watching, is the equity of that growth, and how much that is or is not part of the conversation this time around.
Well, Martin, let me come to you, and then Hung, I'll come back to you on the uncertainty issue, because this volatility has an issue for markets, and we certainly saw that play out 2 weeks ago with what happened in the bond market. That will be part of the conversation here, and certainly the Global Financial Stability Report has a role to play.
We're having some very interesting movements again today, given the remarks about the Fed from the White House. So the risk chapter of the Global Financial Stability Report is something that people should look at, because it's going to try to assess the resilience of the international financial system to these kind of shocks. One should keep them in perspective. The exchange rate, the dollar exchange rate, hasn't moved that much in historical context. We just had a very interesting discussion about the US current account sustainability earlier in the program. There's probably been a recession coming, or a mild recession perhaps, in the US anyway, so one shouldn't overreact. But the fact is that there are surprises possible down the road, and markets can react quite drastically to those. And how resilient are financial institutions, how resilient are non-financial institutions to all that? So there's potential for quite big risks. Otherwise, I would say when it comes to what the meetings should focus about, or what we missed in the past, I think the fund has been pushed aside a bit too easily on surveillance of the large countries. There's been all this talk about how to help development goals. Climate issues have come to the forefront. A lot of focus on equity, which is right, but the core business of the fund, the global economic and financial stability, starts with the big economies. And I've certainly missed something in recent years, which now comes back a little bit to haunt the fund. I don't think that it's been kind of asleep on the exchange rate policy, except perhaps it had to kind of walk a tightrope on China, which has been, if at all, doing a lot of manipulation on the trade side, if not the exchange rate. But the surveillance on industrial countries, advanced economies, I think has suffered a bit in recent years. And that's now, the fund has kind of, to get itself back into a a standing where it can really have a voice on these issues. And it's important for the fund to do that because the expertise is there and there is no comparable institution at the moment that could kind of inject a dose of realism to what is actually going on, apart from the tariff issue, but just the pure economic movements.
Yeah, well said. Hung, on your end, what you're expecting to hear beyond trade?
Yes, to get back to your original question, I am looking at the key theme beyond trades that will be playing out in the next few days, and that is reform and rebalance, as contained in the Managing Director's curtain raiser speech. They are all good, motherhood and apple pie. Countries should reform, US should reduce budget deficit and debt, EU should complete the single market for everything. China should focus more on domestic consumption and less on trade and so on. And emerging market countries should try to mobilize domestic resources to fulfill their development needs. All of that will lead to a balanced and sustainable trade relationship in the world. So everything is correct and should be done. However, I'm looking forward to the Rio to see how much they really deep down and go down to analyze how these things could be done under a very different and difficult international environment. If they were not been able to be done in the past, when interest rates were low, where capital flow were plentiful, where conditions were more easy and more conducive to reform, how can they do that with a completely different and more difficult situation? So I'm really looking forward to see if there's any analysis of that. More importantly, for raising funding for development, fighting poverty, and so on and so forth. What I have heard so far in the past day or two is a bit business as usual. They emphasize, or people, delegates talk about pushing country to mobilize domestic resources. Again, easier said than done, and looking forward to mobilizing and catalyzing private sector capital to fulfill the gap that the official side will be clearly going forward, reducing significantly. Now, everyone talk about private sector money like something that will come and save the situation, but they have to be realistic, and they have to realize that the multiplier of official investment to catalyze private capital investment is low. The joint MDB report, for many editions, calculate that the multiplier is less than 1, around 0.6 times, not multiple of 1. And therefore, I think that what really discouraged me is still the sense of unrealistic expectation. They have to be really down to earth.
I mean, Martin, let me ask you about that, because we're talking about DRM, we're talking about private capital, we're talking about debt restructure, we're talking about the issues we talk about at the IMF-World Bank meetings. This is what we do. But this is not business as usual, not just because of trade, certainly the trade war, but there's something else going on, which is the White House is retreating from international institutions writ large. We see this in the WHO, we see domestically what happened in USAID. How does that impact what is really the heart of economic multilateralism here, the IMF and the World Bank?
I think that's the big elephant in the room standing down there.
2 blocks away.
Even here down there. No, but look, I think the spring meetings around this time is a bit of a holding operation. So not much new. Lots of repeat of established positions that have found a consensus in the past. The big question will be how the US is going to engage with the IMF and the World Bank, for that matter, over the coming months. Personally, and that's just my personal impression, is that I'm a bit optimistic about that. The IMF just had a new Argentina program, and that's not why I'm optimistic, but it was endorsed by the US. The Treasury Secretary went to Buenos Aires, endorsed it. I also understand that the US has now filled its position at the IMF Executive Board.
This is an important development.
Which is important. There was a representative, but wasn't authorized to vote. Now, apparently, my understanding is that this has happened.
And they've announced this? I haven't seen this
I've
yet.
heard it.
Okay.
So
something we'll look for.
Yes. Unofficial.
You've heard it here first.
Yes. But we'll see how it plays out. I think the IMF is in the interest of the IMF, of the US. I mentioned the potential problems that a lot of the export-dependent partner countries of the US have. in Southeast Asia. There are many export-oriented countries. They are incredibly important for the kind of security setup in that region. And if the US needs to support them, it would be very hard pressed to do it by itself. For that, the IMF has ample resources. But we'll see. One thing to look for is the communique at the end of the week, or to say it better, I don't expect a communique, but there's been usually a chair statement that had some agreed language about the economics and what the IMF and the World Bank should do. It didn't get to a communique stage because there were some geopolitical formulations that didn't find a consensus. I hope that the US engages to the extent that we again have a chair statement at least. That would kind of some informal tacit agreement that they're on board. We may get other messages out of the IMF. Maybe they say just, we met and we had great talks, but, let's get back here in autumn. So we'll see. That will give us a bit of a sense of how the US is engaging. But over the medium term, I'm optimistic. Maybe the institutions will have to change. That would be, to some extent, I think also to the better. But we'll have to see how much the US is pressing. It's one of the last areas, I think, where there is an important consensus, because functioning financial markets, a functional international payment system, global stability is something that's in everybody's interest. And it sets the stage for a conflict on tariffs that can then play out, but at least we don't have to worry about financial market meltdowns if it's being played right.
Well, this is why I think all eyes on Secretary Besant's speech Wednesday, where he is supposed to lay out the administration's vision. We don't know where exactly it's going to happen, apparently here at the IMF, so we'll see. But we haven't heard in any great detail from the administration how they approach the IMF and World Bank. And I think this will be the most significant signal so far in this administration of, is this going to be engagement, as we saw in the first Trump term when we were both at the IMF, or a different way of approaching the institution? Hung, on your end, how you see the administration's engagement?
Agree. Pending the speech by U.S. Secretary of the Treasury, we will learn more. But one thing I can be sure that the IMF and World Bank should focus on doing, but which I haven't heard too much about, is how they, each of them, can really refocus their attention and work to their core mandates and try to say, look, we now have many things that we do over the past few decades. These are the things that less important, worthwhile, but less germane to our core mandate. We will divest them. We don't do it anymore. We will focus our resources and our attention to our core mandates and how to define the core mandates consistent with the article of agreement that each institution has had. Because I think that is something that the Trump administration already evident during his first presidency, and I'm sure will be repeated more strongly this time around, is to make sure that the two institutions will stick to their core mandate and not mission creeping into many other things. So I think that is a key discussion that should happen now, but I haven't really seen a lot of those discussions.
What do you make of this chatter in the hallways that, well, it's really the bank that is more kind of be in the administration's crosshairs than the fund? This is what I pick up talking to fund staff.
Well, both. Each has its own challenge.
Yeah.
At the bank, we already seen downplaying of anything to do with climate change or climate finance, even though the president of the World Bank, Ajay Banga, already said that they will continue with allocating 45% of their resources to climate-related activities. So I don't see how that will be reconciled with the Trump's view on climate change. But nevertheless, they are talking more about energy instead of climate. They are focusing on natural gas, nuclear power, and a whole host of different energy sources that are more resonating with the new administration in Washington, D.C. So that is what I've seen.
Yeah.
On the fund side, I think that Martin raised a key point. Funding countries, they have to really think about what kind of conditionality they put in there, and they have to navigate what the U.S. administration want to see done and what they think should be done. So there remain a gap there. Surveillance, normally there will be an Article 4 surveillance discussion with the U.S. this year. So we are very interested and curious to see, one, if that happens on time, usually June or July. if happens, then what kind of discussion, conversation the fund mission team will have with the U.S. government.
Yeah, I think it's such a good point because when I hear that talk about, well, the bank has more challenges than the fund, and you outline the challenges both institutions have, I think of the old Ben Franklin line, we shall hang together, or we shall surely hang apart. And we all know the divides on 19th Street, so I understand it. But I think that's an internal thing. Externally, the administration will do what they will do, and they will approach the Bretton Woods institutions, maybe not at the same time, but they will think of them, I think, more likely as institutions.
One big difference is that the bank requires much more funding to do its.
That's right. It's a good point.
It's subsidized lending, so the IDA component, right, where they give very cheap loans or even grants to developing countries. The IMF also has that operation, and the US is present, but it's not such a big part.
Yeah.
So I
Well,
think
the bank can borrow internationally to fund its operation.
True.
And if it is willing to compromise on a AAA rating, let's say go down to AA plus rating,
big deal.
it can borrow much more. So in a way, the bank has a little bit more leeway than
well,
the IMF.
but if the US would let that, that's another question. But my point is simply that the US is much more present at the repeated funding rounds of the World
Yes.
Bank. The IMF is less dependent on these repeated funding
Yes.
rounds. They just got the quota increase. Now they're supposed to continue with work on the next quota round, which I think is a non-starter at the moment. But in terms of the operations, I think the fund is ready to continue, whereas the bank needs to think about if it has to shift more to its IBRD or maybe even think about its credit rating. How does it do that, and does it really have a mandate from that for the membership? But I think just to echo what Hung said, I think Ajay Banga is a very well placed president at the moment. His credo of first a better bank and then a bigger bank, maybe, I think rings a bell. And as far as I can tell, they're on a good path. Now, whether it's enough, we'll have to see.
So let's take a step back here. Final question before we wrap up. Could you talk about the moment we're in from the Bretton Woods institutions? Something is changing from a trade perspective. We have the world's largest economy imposing massive tariffs, the world's second largest economy retaliating with massive tariffs, new tariffs at a significant level put on almost every country. Help us understand at this moment, there's a lot of talk, this new era we're in. Do you think that's right? It's always hard to know in the moment what's happening, but is something fundamental happening with the US economy and US international financial leadership?
Ask me again in a few months.
Fair enough.
I think, from the outside, everybody who's not in the inner circle of the White House doesn't really know, and maybe even some of the closest advisors don't know where this is going. Is it all a negotiation ploy? Is it a tactic to really maximize concessions from the other side? Is it a conviction that really tariffs are here to stay? What happens if the markets don't agree with that vision? It's kind of not really useful to speculate on it. What's for sure is that the commitment of the US to the multilateral system has changed. But when it comes down to the hard decision, to the self-interest of the US, I still believe that, as I said earlier, that when it comes to global financial stability, that self-interest is there, of course. Yeah. They wouldn't kind of, willingly let a system that helps the dollar dominance and helps the US finance its own government deficits just, go to waste. Yes. Because of, an obvious kind of disagreement with many professionals here in terms of their views and all that. So I think the US probably feels comfortable enough to say, well, we're the biggest shareholder, we can direct these institutions to quite some extent, and that they see that they are in their own interest. That I'm pretty confident about.
Hung, you agree?
Well, I think that the emphasis on balanced and sustainable trade relationship now really, in my view, brings us back to the original Bretton Woods conferences emphasis. Because back then, 70, 80 years ago, a lot of effort has been put into creating a system, particularly with fixed but adjustable exchange rates, that will facilitate and promote adjustment in both surplus and deficit country, so that over time the trade relationship among countries can be sustained on a balanced basis over time. We failed, and I attributed that failure to the IMF among others. Other colleagues may not agree, but I think that the fact that we are now going back to that emphasis in a way is back 80 years ago. So back to the future is my concluding remark.
Yeah.
Okay, we'll take that back to the future.
If I may, actually, that's a good point that you bring up Bretton Woods. The one thing that we should keep in mind is that Bretton Woods worked while there were still very strong capital account restrictions in place. And that's something I'm a bit worried about, that we're going back into a world where free capital flows are no longer a natural element of the environment. And that would have potentially pretty big welfare effects around the world. And we don't know exactly where they're going to fall, but the US would also be affected.
Yeah,
So,
I think that's an important issue if we think about what's different from Bretton Woods.
And basically,
what's similar, but what's changed.
it symbolized in what I say the Triffin trilemma, because we cannot have at the
We
same
got to
time.
Triffin on day one.
Yeah.
This is
So
usually it takes us till day two.
The world cannot simply have free capital flow, free trade flow, free exchange
All
rate,
at the same time.
and sovereignty on monetary policy. They are not mutually consistent.
Yeah.
Something has to give.
the Holy Trinity, yes.
I think the dynamic here is so interesting to me this week because we are going to see hundreds of bilateral negotiations going on with the White House, where every country is trying to meet their counterparts from the Trump administration. Some will, some won't, some will meet lower level, higher level, but every country is involved in some form of negotiation, but they're doing it under the auspices of multilateral economic coordination, the Bretton Woods system and the IMF and the World Bank. And we should just be aware of that contradiction, which is going to play out this week.
And it's not just about trade.
No.
It's also about defense and security
That's
arrangement and so on and so on. So it's really very, very comprehensive set of things going on. And I think it makes things very interesting but complicated to watch.
There's even a geopolitical trinity now, but let's maybe save that for another conversation.
That is why we have a GeoEconomics Center at the Atlantic Council to think about the intersection, not just of finance and macroeconomics, but national security, foreign policy, defense, and how policy operates in practice. We have a full slate of events coming over the next 4 days. Tomorrow we have finance ministers from Pakistan, Ukraine, Turkey, both here at the IMF and at our global headquarters at the Atlantic Council, and special events on the trade war with China, stablecoins, climate, and more. Stay with us at the Atlantic Council all week. We wish everyone a pleasant rest of the day.